On today's show, why stocks are crashing, and is this an opportunity to buy the dip or get out and run? Market sentiment, retail sentiment, fund manager sentiment, and why these stocks are green in a sea of red. We've got a lot to talk about. Let's roll the tape. Welcome everybody to the Daily Recap Show, where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button, and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500, and US stocks were very red. They reversed the gains from about midday after the Federal Reserve slashed rates by 25 basis points today. However, it signaled that it would cut fewer times next year than previously projected. And yeah, a very red day across the board. My portfolio very red, in shambles. My AUD portfolio should do fine because the US dollar was very strong. That should offset some of the losses here today. Nonetheless, a brutal day. The only green we saw was Nvidia up 0.7%, Uber, which is up 2.8%, and like a dead cat bounce here in healthcare plans, up 3.84%, led by United Health, which was up 3.84%. But guys, a brutal day across the board. Small, medium, large value call growth, they all took it on the chin. I mean, the best performing factor indices was large cap core, large cap value, which were both still down in excess of 1%. And look at small caps here, down 1.94%, 1.99%, and 2.08%, nearly 2% across the small segment. It was a pretty ugly day for the Russell as well, guys. Anything that was inflation sensitive just took it on the chin, and that really starts at the small cap space because their input costs rise literally as inflation rises. And it really was just Jerome Powell today. It was the Fed's press conference. Jerome Powell came out to speak at 1:30. And when they got the data, it was just a little bit of a dumpster fire. This is literally a dumpster fire if you've ever seen one, guys. The SPY down 1.66%. And look at the stock at the top. XLV, healthcare, staples, right? XLP, utilities, XLU. These are just defensive sectors. So very clear. This is a liquidation event, and the sectors that did outperform was utilities, staples, healthcare, the defensive components of the market, as well as like the value components of the market. What got hit the most? XLY, the discretionary space, XLRE, real estate, interest rate sensitive stocks, especially in the XLY space, right? Like, for example, retailers, they really do feel interest rates a lot, and it tangibly affects the top line and bottom line. So guys, an ugly day in the market, and it really had to do with these long run projections that we actually got from the Fed, especially the 2025 projections. Now, there was some good news, right? Look at the changes here in GDP. Now, all in all, everything got revised up except the inflation numbers. Look at the September projection for GDP in 2025. The September projection for GDP was 2%. They revised it up to 2.1%. The unemployment rate, September's projection for 2025 was 4.4. They now see 4.3%. Very interesting. This is where things got a little bit out of hand. PCE inflation, September's projection for 2025 was 2.1%. They now see inflation actually ticking up to 2.5%. And then in core PCE, it's 2.2 versus 2.5%. So we definitely saw an uptick in overall inflation. And also what we saw was the federal funds rate. In 2025, they projected the federal funds to be at 3.4. It's now 3.9. In other words, we should see fewer cuts than expected next year. That is to combat the higher inflation, but the fewer cuts should help the unemployment market and the growth picture. So that's what the market's trying to grapple today. And the truth is, when it comes to headline data like this, the market is just going to sell. They don't want anything to do with high inflation. Like I said, it's accretive to input costs. It's not good. And that's why we saw a rotation out of the markets and probably just into cash. We saw the dollar do some very weird things, and we saw interest rates rise as a result significantly. But we'll talk about that when we go on to the charts. But apart from the FOMC economic projections today, as well as the FOMC conference, we actually got some very upbeat data Now, building permits was very, very positive, and this goes to show that lower rates are starting to be felt by the housing market, and that part of the economy, the residential fixed investment part of the market, that part of the economy is starting to open up. Building permits, the consensus was for 1.43 million, came in at 1.5 million. That's a huge beat, guys. And we also saw the previous number revised up. And then look at the month-over-month figure, 6.1% increase versus the forecast of 1.3%. Huge. Now, housing starts were not as positive. The expectation was 1.34 million. We came in at 1.289 million. So housing starts not quite as upbeat. And then the month-over-month figure was negative 1.8%. So less houses were started than expected. However, building permits, which essentially is just future demand for housing starts, did increase significantly. And so we should see this figure right here, the housing starts figure, tick up over the next couple of months. Very positive momentum. Other than that, the market really just moved on the back of what Jerome Powell said. Now, there's no point to talk about the red stocks because we know why they were red, but there were a couple of green stocks and green stories in the market. Now, Nvidia was up as much as 3% at its highs following an information article that detailed how Nvidia could have a plan of its own to compete with hyperscalers through cloud services. The report detailed that Nvidia has already been selling AI cloud services, and it could eventually generate 150 billion in revenue from software and cloud services per the information. The move would help Nvidia continue to play a role in the build out of AI as focus shifts from buying chips to the use case for cloud software. Now, Nvidia did actually see a little bit of a pullback here from its highs, but still up so far, 1.19% for the day. United Healthcare was up 3.8% today. And again, this was probably that defensive trade, and that's why we saw United Health 3.8% today. And then we actually had Uber up 2.33%. Now, to a degree, I think United Health and Uber seeing a little bit of a dead cat bounce, but the reason why we also saw Uber up nearly more than 2% today and at one point nearly up 4% on the day was simply because Bernstein held their outperform rating, raised their price target to $95 a share from $92, and they pretty much stated that the growth outlook for ride sharing remains very, very solid, and they should be able to generate free cash flows in excess of market expectations. And a $92 price target would represent 50% upside from where we are right now. And guys, but all in all, despite the green we saw, markets were very, very red. Now, longer term averages, the 100-day, 150-day, and 200-day remain intact. And that's a very, very good thing. The longer term trend is up, but we really are starting to see the market wobble here with the shorter term and medium term averages, particularly the 50-day. We saw deterioration in these averages again from 48 to 42, 32 to 25, and 25% to 19% here in the 5-day, which is fairly noisy. But these two, the 20-day and the 50-day, and, decreasing significantly. Look at it just from last week, right? We've seen a massive deterioration in overall market breadth from very healthy levels right here to where we are right now. Now, all of this can change in a single day. And I do think that when we get the PCE report this at the back end of this week, if we see a cool figure there, all of these gains will be reversed. But I wouldn't be too hopeful because we saw inflation tick up in the CPI report. CPI and PCE are heavily correlated. There are some differences with the weighting to each component. Nonetheless, we should see a pretty sanguine PCE report that's probably going to build on the Fed's narrative that they do probably need to keep less rate cuts into the end of the year. And all the Fed are really trying to do is just manage their dual mandate, full employment and stable prices. And as a result, richly valued stocks, the market we are right now, is going to have a pullback. But that happens. Pullbacks are normal. It happens. It just so happens to be in the seasonally bullish time period, but it is what it is. Any pullback we do get, guys, we still want to buy those dips. Why? Because the longer term averages look very, very solid. Let's hop on the charts. And then looking at equities, looking at the charts, guys, very ugly day across the board. The S&P 500, Nasdaq 100 down, nearly 3%, 3.5% in the Nasdaq 100. The IWM down 4%. Higher beta, higher risk. It means more upside potential, but more downside potential as well. And that's what you get when you invest in something like the IWM. And there was no real safe place today, guys. There was no real safe place apart from cash. The dollar gained. That's because yield rose on the back of that high inflation narrative we're seeing. Volatility up 46%. Crazy. And we also saw commodities. There was no safe havens. Gold was down 2%. Silver was down 3%. Bitcoin down 4%. Crude down 0.32%. Like commodities, stocks, crypto, bonds all fell. I got stopped out of my Paycom position as well. It was down like 7%. I had a very, very tight trailing stop. I got stopped out like right here. So what's it down now? Yeah, down 9%. Glad I got stopped. I got stopped up at about down 7%. I was the position I was up about 56% in total. I bought around the 150, 151 mark, sort of around here. I had a pretty good run, and yeah, out of the position, which is great. PayPal, guys, PayPal was not a fun day today as well. It was down nearly 6% here today. Absolutely crazy move in PayPal. And it was just red across the board. Another stock I own in my portfolio, Meta was down 3.4%. And then we look at Visa. I think Visa might have been one of the best performing, only down 2.59%. But if we actually look at the S&P 500, brutal day. Look at that candle. That's a bearish candle. And I think this probably stops the December rally. The seasonal trend, we're thinking of getting the seasonal run up in stocks. And this probably means we are going to see higher yields, and you're going to see these smaller names get hit the most. Stuff like the RSP, the IWM. I think the place you'd actually want to be is probably these mega caps, these high quality mega caps that can withstand higher rates and a high inflation environment, because that's where we're going, right? We will see bumpier inflation than what we're seeing right now. That means yields are going to rise, and the market doesn't really want anything to do with that. And that's why we saw this ugly candle. And we could probably correct 10% from here. And if we are to see a 10% correction, that would take us from where we opened the day. 10% would be, close to the 5,400 level. That would be a great opportunity to get long. We're probably about 25% of the way there, and see where these lines fit out right now. But as it is, we are seeing a little bit of support here at the put support zone, which is very, very crazy. So we moved from positive gamma into negative gamma, finding support here at the put support. So we'll see. Maybe we actually do stabilize here and then continue the seasonal trend upward. That would be positive. I'm not saying we're going to go back and get those highs. This was an ugly candle, and the narrative behind today's trade is not that great. Nonetheless, this is still shaping up to be an equal low, and we're sort of holding the Trump gap up. So that is constructive, all things considered. If we also look at the Nasdaq 100, very similar price action to the S&P 500. We're holding the put support level right here. We are in negative gamma, and we are seeing a little bit of buying action here with these wicks market is coming into. However, not an equal low. This is probably the low you want to look at right here, or that would signal a lower low or an equal low in the Nasdaq 100, which means the Nasdaq 100 is probably looking like the best place to put your money. Now, the IWM, the RTY, the Russell 2000, just a dumpster fire. This is literally a lower low relative to this low, which means this is the next low that we need to look at. The put support right here is at this level, and we probably will get to that level. So probably more downside in the Russell 2000. We probably will see some downside action in the after hours, and that's exactly what we're seeing right now. Look at the IWM, look at the Qs, look at the SPY, a little bit of downside action. We're seeing the RSP, a little bit of positive momentum. It looks like the RSP finished down 3% for the day. Absolutely crazy price momentum we're seeing. So guys, all we want to do right now is we need to evaluate the incoming data, particularly the PCE data, and then we need to make a decision as to what happens next. Now, I got stopped out of Paycom, so I have quite a bit of cash ready to deploy if this dip keeps on dipping. So I guess that is a good thing. And I did make money on that position, significant money. So look, I am sitting in cash right now. I'm sitting in a lot of cash right now, looking to deploy it. Now, I'm not saying we're going to pull back 10%, but if we are to pull back 10%, I'd be taking that opportunity to buy the dip, because all in all, even though inflation is going to remain slightly stickier than expected, that's because we have a robust labor market, a robust consumer, a robust economy. That's exactly what you want to see, right? If inflation is going to tick higher, you want it to be backed up by strong fundamentals. And we do know that the macro and the fundamentals are really, really strong. And so, we're just seeing the market reprice risk, and that risk is simply just high interest rates, probably higher interest rates for longer, less rate cuts than we initially thought, and the market needs to discount that back, because we did get a little bit frothy with the amount of rate cuts priced into the market based on the earnings potential for the market next year, and that could mean we could fall further. Guys, I wouldn't be surprised if we actually continue to move down. We are in a seasonally strong period of the year, don't get me wrong, and if we do actually find support, we could actually find a move higher from these levels in the S&P 500. But it's very clear the trend right now is to the downside. That's an ugly candle, right? We opened, rallied all the way lower, closed at the low of the day, inside negative gamma. Things looking very ugly here in the after hours as well. All you really want to do now, guys, is get ready to deploy capital at lower levels because we probably will go lower into the month of December. The Santa rally has been cut off up until the PCE print. If we get like a really cool PCE print this coming Friday, then we could start looking at maybe things turning around. But until that time, until that happens, but until Friday, if we get a cool PCE print, expect volatility to maintain to the downside, expect an uptick in the VIX, expect stronger than expected yields, a stronger dollar. That's really going to hurt stuff like the IWM. Large caps should see selling, but less so than the broader market. But do expect defensives to outperform and large caps to outperform, relatively speaking. Ugly day in the market, not what you want to see. However, opportunity to buy the dip because at the end of the day, the fundamentals, guys, and the macro remains very, very strong about stocks, the economy, and you want to buy any short-term weakness, any short-term pullback in these markets because at the end of the day, we will be higher this time next year in the S&P 500. So buy the dip, but not just yet. We probably will go lower unless we get a cool PCE print and see some very, very dynamic consolidation at these price levels.
And let's talk about sentiment. This is Citigroup's panic and euphoria model, their take on market sentiment. And pretty much market sentiment has been bullish all year. This sustained optimism signals bullish momentum and pretty much means investors are piling into risk assets. And pretty much for the entire year, we've been in euphoria. And that's because US equities have just simply worked. And guys, bullish sentiment is not a reason to get bearish. If you sold this tipping into euphoria here in February as well as March, maybe April, sure, you would have had a bit of short-term weakness, but that's all it really was. Just short-term weakness, and the market has just continued to rip higher. Very linear returns in the S&P 500. Bullish sentiment is not a reason to sell. It's actually a reason to get ever more so bullish, especially when the fundamentals of the economy are super strong. And fund managers actually recognize that. FMS investors or fund managers have their cash allocation to the lowest on record. In other words, they're piling into equities, they're piling into stocks, into risk assets, into Bitcoin. And that's just the market showing a vote of confidence for where we're going into 2024. But then we really have to ask the question, why is something like the RSP, the equal weight, down in the last 10 days or the last 10 trading sessions? Well, there's a lot of dynamics at play. And it actually mostly has to do with earnings, guys. Earnings is the number one driver of market returns in virtually any year. For example, 2020, stocks fell a lot. Why? Because we saw earnings fall a lot. 2021, stocks were very bullish on the back of COVID. Why was that? Earnings grew in a substantial way. And in 2025 and in 2024 or 2025, earnings have remained pretty much flat. Revisions have been very, very good. However, in the last couple of weeks, we have actually seen a bit of downward revisions. And that is actually why we're seeing the market pull back, particularly the equal weight, because the big players, the big dogs, they're not going to see their earnings revised as much. You're going to see the smaller players in aggregate. They're going to get their earnings revised the most. Also, the reason why we're seeing this dynamic in the market right now, the RSP pulling back along with earnings, it has to do with tax loss selling, window dressing, and reinvestment reallocation. And as a result, what fund managers are going to do is simply buy the winners that have won this year, sell the losers. And that simply means you're going to see a huge allocation into names like AVGO, Tesla, Amazon, Apple, Microsoft, Google, Meta, and an exit from all the other names. And that is why the RSP has actually pulled back while the S&P 500 and the mega cap names have actually marched higher. It's because their earnings are not getting revised down as much, and all of the capital reallocation is getting reallocated to these stocks. And that's why we're seeing a bit of the dynamic we're seeing. But once we get past this churn over the next couple of weeks, maybe the next couple of days, onward and upward. And if we actually have a look at the big winners this year, definitely see it's tech, comm services at the index level actually beating the average stock. Same with the discretionary space. These three sectors are pretty much the Mag 7, semiconductors, technology, Amazon, Tesla, Google, Meta in comm services. And then we have financials here as well, holding the boat for the broader market, excluding those tech names. Then you actually look at stuff like utilities and industrials, the average stock actually beating the index, which means there's some heavy losers in these indexes, and the actual average stock doing really well. Staples, absolutely ugly, very similar to tech. When you see the sector return year to date more than the average stock, it probably means there's a big winner in that index. In comm services, that big winner is Meta. For example, in the tech sector, that big winner is Nvidia and AVGO as well. And you can see the rest of the market following trend. But guys, every single sector this year, except 4 sectors, has returned 20% plus gains. Absolutely crazy. Energy, real estate, materials, healthcare. These are the only sectors with gains not greater than 20%. And you can see real estate and energy still reporting double-digit gains, all things considered. So it's been a very bullish year. This is why market sentiment is so bullish. Look at that. Comm services up 46% for the year. Wild. Just crazy stuff you only see in a bull market. And this is all just backed up by the macro environment. Let's go back to sentiment, right? But sentiment on the overall macro. And you can see what is the most likely outcome for the global economy in the next 12 months. No landing, soft landing, hard landing. This is where we are right now, the most up-to-date figures. And those looking for a hard landing, virtually non-existent. It's probably less than 5%. Those expecting a hard landing. The consensus right now is either no landing or soft landing. And that just goes to show the overall resilience and strength of the US economy and the US consumer. And growth looking very robust, all things considered. While we have seen a little bit of a pullback in overall growth metrics for Q4, the tracking estimate, we're still above 3% at 3.1% in the Fed's GDP now. And again, you can't fault the growth. And another metric supporting the overall strength of the economy was retail sales. Retail sales month over month came in at 0.7. We were actually expecting 0.5. Very strong figures owing to the strong consumer and the strong holiday period ahead. And this bodes really well for Q4 earnings, especially in names like PayPal, Paycom, Meta, Google. That's exactly the type of stuff you want to see. So Q4 earnings likely to be blockbuster given the retail sales print, and we'll have to look at the remaining data to see where we go. But everything is looking really good for a robust Q4 earnings season. And looking at data for the rest of the week, guys, it really does kick off tomorrow. We get the GDP revisions, the quarter over quarter. This is for Q3. As you can see right there, we get the growth rate and the price index. We then also get initial jobless claims, existing home sales year over year and month over month, and then the Philly Fed manufacturing index. Now, this is what you really want to look at, right? The GDP growth, the final revision figure. Now, the consensus expectation is 2.8%. If we get a figure above 2.8, markets are going to rally. Below 2.8%, the markets might find that a bit sour. Initial jobless claims, the forecast is for 235,000. And then for existing home sales, we're looking for 3.97 million and a 1% growth month over month. If we get that, Bob's your uncle, off to the races. Looking at earnings for the rest of the week, tomorrow we have Accenture before the open. Then we also have FactSet Research, Paychex, and CarMax all reporting before the open. Then after the close, we have Nike and FedEx. Those are the big ones. So a big day on earnings, a big day on Thursday. We also had a big day here on Wednesday, and then Friday we have Carnival and Winnebago. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit the notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.